Most people think reinsurance simply is insurance for insurance companies. And technically, this is true. But sophisticated insurers use reinsurance for something much bigger, which is capital management. Because reinsurance doesn't just reduce risk, if you think of it, it can completely reshape capital requirements, ROE, growth capacity, and strategic flexibility. Right? Here we go again. Hello everyone, this is Diego and welcome back to the channel. Here we're going to discuss quite a bit of FP&A, insurance finance, and the strategic mechanics behind how insurers really operate. In the last video, we talked about economic capital versus regulatory capital, which is very nice to understand. And today we will explore how reinsurance itself becomes a strategic capital management tool. Sit down, grab your cup of tea, and here we go. What reinsurance really does. At a basic level, reinsurance transfers part of the insurer's risk to another company, the reinsurer. This helps reduce exposure to large losses, catastrophe events, and portfolio volatility. But strategically, what matters is what happens to capital after that risk transfer. Because when insurers reduce risk exposure, they often reduce capital requirements as well, as we discussed earlier. And that changes everything. Okay? Now, the capital effect. Let's discuss this very quickly. Think about it this way. If an insurer keeps all the risk on its own balance sheet, it generally needs to hold more capital. Okay? More exposure means more volatility, higher solvency pressure, greater earnings uncertainty, but by ceding part of the portfolio through reinsurance, the insurer can stabilize earnings, protect solvency, improve capital efficiency, and sometimes support growth without raising additional capital, which is very nice. So reinsurance is not just a protection mechanism. It becomes a balance sheet optimization tool. Okay? Now, how insurers use strategically this tool of reinsurance? Different reinsurance structures support different strategic objectives. For example, you may have a quota share agreement that can reduce capital strain and support growth, okay? Excess of loss structures help protect against severe events and earnings volatility as well. And catastrophe reinsurance protects against tail risks. And the interesting part is the decision is not only about reducing losses, it's about optimizing return on capital, risk-adjusted profitability, and long-term resilience. The trade-off. There is a trade-off, yes. Of course, reinsurance is not free, okay? Insurers have to give up part of the premium and profit to the reinsurer. So there's always a strategic trade-off. Do we retain more risk and potentially earn more, or transfer part of the risk to improve the capital efficiency? Strong insurers constantly evaluate this balance because the goal is not maximum growth, as we discussed. The goal is sustainable capital efficient growth, okay? Now, a real-world example as I like to bring to you. Imagine an insurer expanding into a volatile line of business. Without reinsurance, the capital requirements could become extremely heavy. But with the right reinsurance structure, the insurer may reduce volatility, free up capital, improve solvency metrics, and scale more strategically. That's why reinsurance is deeply connected to capital management. To close off this video, I would say the best insurers don't see reinsurance as just a protection. They see it as a strategic lever, a tool to manage capital, optimize returns, and support long-term resilience. In the next video, we will explore how IFRS 17 changed everything in the game of insurance accounting. Follow the series if you want to understand more about insurance finance beyond the surface level. Once again, thank you for considering subscribing to the channel and watching the whole video. I'll see you in the next video for us to keep sharpening our craft together. Thank you, see you, bye.